Welcome again to Etienne's Place. It is nice, sunny, warm in Georgia. As a matter of fact, today I think it's somewhere about 72, 74 degrees. So it's very pleasant to know that a couple of days we were freezing, but now it's almost summer-like temperature. So we're blessed here in Georgia. Welcome back once again to Etienne's Place. My name is David Etienne. We have been having fun in this place because I've been having all your feedback. And whereas I thought that I could have had a little farming in terms of things to speak about, but I've been having overwhelming responses from quite a number of persons. And so you have been feeding me information. And so going forward as we do, the things that we speak about in Etienne's Place will be as a direct response to the questions that you have, to the concerns, and to the answers that you seek. Again, I encourage you, subscribe to Etienne's Place so that you'll be kept informed. You'll be able to access all our past videos, and you'll always be notified when new production, new material is posted so you can be kept informed. So once again, welcome. Now today, I want to look at three components that are of significant concern to our taxpayers in general. The first thing I want to look at is what is referred to as standard deductions as opposed to itemized deductions. Very simple concept, but one that tends to have taxpayers a little confused because taxpayers will come and they will have a number of things that qualify as deductions on their tax returns. And they'll say to me, okay, I have these deductions. I'm expecting to get significant benefits from these deductions. And my response at times would be, oh yeah, they will not help you one bit. And they're taken aback. And I thought that, okay, a clear explanation as to how the standard versus itemized deduction work would be, quite informative and will guide. But here goes. And I'm going to use a very simple illustration, simple example to illustrate. Let us say that you have an income of $100. That $100 would normally be taxable. The IRS, the government is saying, I'm going to give you a break, a tax break. So here's what I'm going to do. Instead of taxing the $100, I'm going to deduct from it $20 and put that aside. Then I'm only going to tax the $80 remaining. Once I'm through taxing the $80, then I will add back the $20. As a result of that, instead of paying taxes on $100, you end up paying taxes on $80. That $20 represents your standard deduction. And it's something that is given automatically. Once you are a taxpayer, you're preparing your taxes, you will always automatically receive what is known as a standard deduction. And earlier on, you would have heard me say, and you may have read it all over the place, that as of 2018, the standard deductions has doubled. So basically, we're talking about $18,000 is the standard deduction. So whatever your income is in 2018, before taxing that income, you're given a benefit by having 18,000 taken away from that number. The balance is taxed, and then the 18 will find its way back into your overall picture. But the fact is, you'll get the benefit of a standard deduction. It's called a standard because it is fixed, it is given. You don't really qualify for it by doing A or B or C. It is just something that is provided as a help, as a relief to help you in your, with your tax burden. That's your standard deduction. So for 2018 onwards, until there's a change, the standard deduction is $18,000. On the other hand, there's what we refer to as itemized deductions. And here's the principle. The IRS, the government is saying, I will automatically give you the benefit of a standard deduction of 18,000. However, if you have other deductions, and these other deductions are referred to as itemized deductions. So if you have several other deductions, which when you add them all together, you end up with a total that is greater than the standard deductions that you get automatically. The IRS is saying that I will allow you to forego using the standard 18,000 and use your itemized deduction. But of course, as a taxpayer, it only makes sense for me to opt for the itemized figure if the total of that itemized list is greater than the 18,000 standard. That's naturally. If the deduction is, as it says, a deduction to help me, then the larger the deduction is, the better for me. So I will only gravitate to my itemized deductions total if that figure is greater than the standard automatically received standard deduction of 18,000. So again, and some of the items that fall on your itemized deductions list would be like your property taxes, medical expenses, mortgage interest, contributions to charity, those kind of things, and some other stuff, okay? All those are listed on what we refer to as a Schedule A. It is totaled, and that is its sum total of your itemized deductions. It only makes sense to use that number if it is greater than the standard deductions, which as of 2018 amounts to $18,000. Good. So when I tell you, or your tax preparer tell you that, okay, yeah, you have mortgage interest, yes, you have property taxes and a lot of other deductions, but they are of no use to you because when I add them all together, they do not equate with, they are not greater than the 18,000 standard. That's exactly what it means. It's better for you to go with a larger number. All right. So that is it in basic, simple terms as to the comparison between what is referred to as your standard deductions and your itemized deductions. Quickly, moving on to earned income credit. Now, I want to speak to earned income credit, not so much as to how you qualify, because I think we had mentioned that earlier on, but I want to speak to earned income credit in relation to the income type of the taxpayer. Now, it is called earned income credit, meaning that it is a credit that comes about in relation to income earned, among other things, but income earned. It implies, therefore, that if I have other income that was not earned income, and we say earned income here meaning I worked for this income. So if I have other income that was not as a result of me working for it, it was not earned income. It is referred to as unearned income. Sometimes we talk about it as being passive income. So for example, good examples, rental property income. It is part of your income for tax purpose, but it is not earned income. Investment income. It comes into the picture as part of your overall tax computation, but it is not earned income. Those things are referred to as unearned income. They are taxable income, but unfortunately, because they are not earned income, they do not qualify you for the earned income credit. So I have a client who up to 2017 was earning an income, has about 3 or so dependents, and was getting quite a decent refund year over year. For the current year, this person no longer has earned income. This person has gone into quite a bit of rental property. And as a matter of fact, the income generated by the rental activity even exceeds the other income, exceeds the earned income of prior years. This person came out with a totally different result. Why? Because a significant portion of that person's prior year tax computation and ending results had to do with the earned income that was triggered by the fact that the person had earned worked for their income. This year, 2018, they had more money in their pocket, but it was not money as a result of working for it. It's as a result of other activities that are referred to as passive activity. You sit aside and your investment earn interest. That's passive income, unearned income. You have rental property, and yes, you may be actively participating, yes, but for purpose of the earned income credit, that is not earned income. And so suddenly you find that, okay, no earned income credit. Very important to note. It's not called earned income credit by accident. It is a credit that is triggered, stimulated, generated on the platform of income earned as a result of working. Okay? Very important, because some people are saying, why up to last year I was getting earned income credit of so much and suddenly, but yeah, earned income credit has to do with earned income, active income earned, not passive income as income earned through rental activity, investment activity, etc. Okay, so that's it. Next thing, we move on to the child tax credit. The child tax credit, yes, was $1,000 before. It has moved to $2,000 per child. Good. Again, the child tax credit is one that, first and foremost, once your taxes are calculated, and we know what your tax bill ought to be, or the resulting tax bill, then what credits do is to, as I said before, dollar for dollar, reduce your tax bill. So for example, if after working out your taxes, you end up owing $500 tax, then if you're entitled to, up to 2017, if you're entitled to $1,000 child tax credit, what you would find is that, okay, my $1,000 child tax credit will jump in and totally erase my $500 tax liability, and I'm good for that. In the same vein, I want to speak to what we refer to as refundable and non-refundable credits. Sticking with the child tax credit, up to 2017, what your child tax credits would do is serve to offset, yes, your tax liability. As a result of that, you may not owe any more taxes, and then that was about it. That was about it. It was a non-refundable, meaning that whatever portion it takes to remove your tax liability, that would happen. If you have an unused portion, it was not refundable. One way that the tax system facilitated taxpayers to get around this is to have another category referred to as additional child tax credit. So whereas, for example, your $1,000 child tax credit, if you only need $400 of that to clear what would have been your tax liability, then you would not be getting, after the 400 clears the liability, you would not be getting the 600 as part of your refund, normally, because it was not refundable. However, there was the additional provision of what we call an additional tax credit, child tax credit, and it was through this additional child tax credit that you would end up getting that portion of the unutilized child tax credit as part of your refund. 2018 forward, things have changed. We now have the child tax credit being a refundable credit up to $1,400. So quickly again, I work my taxes, I end up with what would have been a tax liability, me owing taxes of $1,000. My child, I have a single dependent, I qualify. So right away, I'm owing $1,000. I would have owed, the calculation says that, David, you're going to owe $1,000 for taxes. But then comes my child tax credit, tip, and come across, and my child tax credit values $2,000. So right away, that $2,000 hit that $1,000 that I would have owed and erases it. I owe no more taxes. But it's only 1,000 of the 2,000 that was applied to that potential tax liability. What happened to the other 1,000? Good. As of 2018, we now have the child tax credit being a refundable credit. And what that means is that after you have used a portion of this credit to offset potential tax liabilities, if there's still an amount remaining that is not yet used up for that purpose, you can then get it as part of your tax refund. That is wonderful. That refundable portion is only to the tune of $1,400. So if I qualify for $2,000 child tax credit, and I only needed $200 to erase potential tax liabilities, it means that I would have $1,800 of that credit left over. The credit is refundable, but only to the tune of $1,400. So I would not get the full $1,800 remaining as part of my refund. I would get $1,400 of that $1,800 remaining as part of my refund. So sometimes, with this new law, people are going to tax preparers and expecting, okay, I'm expecting to get an automatic $2,000 child tax credit. It doesn't work that way. A portion goes to offset your tax liability where it exists. And if there's a balance remaining after that action has taken place, then you can get a portion of it refunded to you up to the maximum of $1,400. So there you have it. We looked at the standard versus the itemized deduction. Again, I like to remind you, we're not getting complex, we're not getting technical, we're keeping it very, very simple, basic, very easy to understand. Like anything else, if you want to, mine a bit deeper into this thing, there's a lot of things we can talk about, but that's not the purpose of our forum here. So we looked at the standard versus itemized deductions. We looked at the earned income credit in relation to the type of income, whether it be earned income, which is what draws in the credit, as opposed to unearned income or passive income, for example, rental property investment income, which then, ain't gonna pull that earned income credit into your returns. And then we look at the child tax credit, where we're saying, yeah, child tax credit is wonderful, it's great. It goes first towards, like all credit, goes first towards reducing your tax liabilities. But if after doing that, there's still a balance of this credit that is sitting there unutilized, you have the opportunity to have it included in your refund, but not the full balance, only the unused balance up to $1,400. So there you have it. Very basic, very straightforward. I hope you got the lesson, or the tidbits that I offer here. And as usual, try to be informed. You don't have to get technical, you don't have to get all convoluted with tax laws, etc. Just a basic understanding is what you need. And you owe it to yourself, because you're the taxpayer. It is your taxes that are being prepared. You need to know what is going to your taxes. You need to know, even on the micro, well, not the micro, I think it would be the macro, the broad, on the broad level, as to exactly how these tax rules and tax laws impact you and affect you. So thank you again for joining me at Etienne's Place. Remember to subscribe to our channel so that you're kept informed. Subscribe and invite your friends, your neighbors, your family. Tell them about Etienne's Place, and look forward to seeing you over and over. And again, remember, at Etienne's Place. At Etienne's Place, this is where we come for solutions to simple problems, sometimes complex problems, yes, but the point is we try to keep it simple, straightforward, And so once again, I look forward to joining you next week, and keep the questions coming, keep the comments coming. And as you send in to us your concerns, your questions, then I will always structure my presentations in a manner that hopefully will address these issues, keep you informed, keep you educated, and ultimately make you be successful in your business life and in your personal financial life. So God bless, walk straight, live good, love one another. I'll see you next week.